Legendary stock investor Warren Buffett has sold a lot more of his stock holdings. Ever since the share sales showed up last summer, everyone in the investment world has been asking why. Of greater concern, a lot of those sales more recently have been zeroing in on the banking sector. And according to the latest SEC filings, it isn't just Bank of America that Buffett's Berkshire has been disposing of. Now, Berkshire Hathaway began trimming its massive BofA position last July, raising all sorts of caution, particularly after the carry trade blow-up and volatility last August. Banks are heavily exposed to cyclical risks, which is what the carry trade blow-up really had signified, not to mention how not long afterward, the Fed began cutting rates after recognizing the same thing, whether officials will ever admit it publicly or not. In other words, it was the timing for Buffett's actions as much as the target. As it turns out, the target wasn't limited to strictly Bank of America. If the credit cycle begins to more visibly impact banks, then the risk to stocks goes way beyond banking shares. Stocks only ever get sold down during recessions, and shareholders know this. They all wait until they get confirmation in the form of traditional signals like negative GDP, falling payrolls, or maybe bank credit trouble and junk credit spreads. We haven't seen those because this is not a usual recession cycle. A forgot how to grow economy doesn't come up on the stock market's radar as a sell trigger. But the negative fundamentals behind the forgot how to grow economy are eroding the credit system and could potentially trigger a recognizable warning via bank operations, meaning bank earnings, therefore a wider signal. Now, whether or not that's why Berkshire Hathaway has been selling stocks or even bank stocks, that's an open question. Unfortunately, Mr. Buffett did not respond to my repeated requests for clarifications. But you know the old saying, where there's smoke, there's very likely a very frigid, cold economy experiencing a hiring freeze that doesn't look like a traditional recession because it forgot how to grow. There's a whole bunch of signals that we need to unpack here, starting with Buffett and Berkshire Hathaway, but it isn't limited to just what Berkshire Hathaway is doing in the banking sector. There's a whole bunch of complacency combined with the fundamentals of the forgot how to grow economy that you can understand easily. If Warren Buffett sees the same things, why he would be selling so many of his shares and so many of his bank shares. One thing Buffett didn't sell was more Apple, but he did sell a ton more of Bank of America. And that's the one that really raised everyone's suspicions last year. The theory that a lot of people were working with was that he was just selling down his position to get below the reporting threshold so he wouldn't have to report as regularly on what he was doing with Bank of America. Well, the latest filings that just came out put that theory to rest because he continued to sell well below the 10% threshold. According to Fortune magazine, Warren Buffett's Berkshire Hathaway continued whittling a longtime bet on Bank of America Corp. in last year's final months, while keeping a stake in Apple intact following an earlier reduction. The Omaha, Nebraska-based conglomerate cut its stake in the bank to 8.9% in the fourth quarter after selling 117.5 million shares, a regulatory filing last Friday showed. Bank of America executives and shareholders have waited for months for the update after Berkshire's prior sales left it with less than 10% and freed it from a requirement to quickly disclose transactions. The remaining holding was worth $31.9 billion as of last week's close in trading. Buffett, who's 94 years old, started whittling the investment in mid-July 24 without providing any explanation. And the timing was, as I said, just as suspicious as the target, given the shift in the fundamentals, the perceived fundamentals in parts of the marketplace over the U.S. economic position. And if the U.S. economy's fundamentals are shifting, what does that do for the wider stock market? Forgot how to grow economy begins to show more signs of recognizable recession, something that the stock market is trained over and over to focus on, and really that's the trigger for sales. And according to that latest filing, Berkshire Hathaway cut its holdings in Bank of America down to 680 million shares at the end of last year from a billion shares 6 months earlier. But here's the thing. They also sold a whopping 74% of their Citigroup stake, not to mention they sold 18% of their Capital One holdings and more than half of their new holdings position, which is a Brazilian-based company that's become the world's largest digital banking company. And they also cut back on stocks in things like Louisiana Pacific and T-Mobile and Charter Communications. But it's the banking stocks that we're going to focus on here because of the role that banks play, not just in terms of the credit cycle, but also how that signals to the rest of the stock market and maybe even the real economy about where things are likely to be going. You got a lot of complacency in the share markets, plus fundamentals that may be deteriorating, and who better to know fundamentals deteriorating in the real economy than Warren Buffett through his close information and the ability to digest information in the banking sector. Banks know what's happening in the real economy, and their actions can tell us a lot about what that means for a lot more than just banking stocks. In the context of Warren Buffett and Berkshire Hathaway, it would also be the stock market as a whole. The forgot how to grow economy, the unrecognizable signals of a non-traditional recession process, that's something that we talk about and write about a lot at Eurodollar University's Deep Dive Analysis. And right now we've got the last couple days of our President's Day sale, some of the best prices we've ever offered on especially a bundle, the Deep Dive Analysis, where we go deep into these topics, especially what the forgot how to grow economy is and how to recognize it and what it ultimately means, plus the daily briefing as well as a membership. You get all three of those at one very low price and all the details for our President's Day sale, which is only effective for another day till tomorrow, Tuesday. All the details at our website, eurodollar.university. As far as the stock market overall goes and what shareholders are looking for, that's pretty simple. Stocks go down when there's a recession, and it makes sense because a stock is a financial asset in perpetuity, and perpetuity isn't exactly forever. It stops when the business goes out of business, right? Bankruptcy. Bankruptcies tend to rise and cluster during recessionary periods. So the fear in the stock market is that in a recession, there might be more bankruptcies. Therefore, it behooves someone to get out of those risky assets before finding out whether or not the company that you own, that stock that you own, is of a company heading into bankruptcy. Historically speaking, stocks do not do well during recessions. But it's not every category of recession, every possible pattern of recession. So the stock market and stock investors, they're looking for those traditional recession signals, the sharp drop off in the economy, negative GDP for more than one quarter, negative payrolls, rising unemployment that goes beyond what Jay Powell says is no big deal. And by the way, it's the same thing in credit markets too, junk credit markets. Junk credit does really badly during recessions. And so investors, whether it be in risky financial assets like stocks or risky bond market and credit assets like junk corporate debt, they're looking for these signals of a traditional recession to tell them that that's when to sell. And in this forgot how to grow economy that doesn't look like a traditional recession, even though it is one, nobody sees these signals and says, oh, that's a recognizable recession. I need to start selling. If there's one really insidious factor, a really insidious outcome of the forgot how to grow economy, it's the fact that it doesn't look like anything. It doesn't look like the traditional recession process, nor does it look like a booming economic period or an economy that is actually sustainably strong and resilient. It doesn't look like anything. You see all of these statistics, especially in the labor market, but I also went over industrial production and retail sales, especially in real terms. They go sideways. We see this all over the world, and sideways is not a signal the stock market is actually looking for. But the fundamentals that are represented by the forgot how to grow economy, whether it's sideways or not, means that the chances of getting more signals that look like a traditional recession goes way up. And so once you get those signals, everybody starts to sell. So you have to anticipate the point at which everybody's going to get those signals. And in the fundamentally negative situation of a forgot how to grow economy, it's high degree of complacency because it doesn't look like a recession, plus the heightened risk of it eventually looking like enough like a recession that leads the stock market vulnerable. Then you throw in high valuations. Everybody's just completely convinced of a soft landing. Jay Powell's got everything covered. And we've all seen this too many times before. What happens when everybody's complacent about financial risks, when the fundamentals, whether they recognize it or not, continue to get worse and worse and worse? Well, one place that you can look at for deterioration and degradation in that direction, the banking sector. And it's the same thing, like I said, in terms of junk credit as well. You've got spreads that have been narrowing in junk credit for the last couple of years, really since 2022 and early 2023, because again, it doesn't look like a recession. And furthermore, the more spreads compress, the more the market takes that signal that everything must be good. It's the same circular reasoning that you see in stocks. The higher stocks go, the more people think that stocks are signaling everything is fine. And everybody believes that stocks are up because the economy is great. And then they say that the economy is great because stocks are up. Same thing in the credit markets. Lower spreads are said to be because the economy is strong. And we know the economy is strong because we can see that in low risky credit spreads. You get the circular reasoning that defies all the evidence as well as basic common sense when you look at the data objectively. The reality is the economy, not just in the United States, but all over the world, is in bad shape and it's getting worse. Even if it just continues to go sideways from here, that continues to add to the contraction because we live in a nonlinear world and lack of growth is every bit of a contraction as if GDP was falling off sharply. In fact, the more time you get sideways, the worse it actually is compared to a couple quarters or even a year of sharply lower GDP. We're talking about coming up on 3 years now, which is a whole bunch of negative signals, starting with the fact that it doesn't look like anything is actually changing for the better. It just continues to go sideways, which raises the fundamental risks for a complacent or a couple complacent marketplaces. And so there are parts of the financial system, those on Wall Street, hedge funds, sophisticated institutional investors, who are seeing the same things that Warren Buffett is. Fundamentally, things not good, but also the extreme, exceptional level of complacency in some of these markets, including junk credit. An article reported by Bloomberg this past weekend, the latest Federal Reserve survey of senior loan officers showed banks raising standards by the most in 3 years when they're lending to medium-sized and larger companies. That'll put the squeeze on borrowers already grappling with higher funding costs and global volatility from escalating trade wars. What they're basically saying is economic fundamentals that are not good and then assigning what they believe are the causes of those economic fundamentals. Higher interest rate costs, that's not really an economic fundamental concern, nor is uncertainty over trade wars. What they're really saying is we see the implications, we see the symptoms of the forgot how to grow economy. We don't know where it's coming from. But continuing here. At the margin, a tightening of credit standards puts more companies in serious risk of default, said Fridson, a former strategist at Merrill Lynch, whose debt analysis has been studied by Wall Street for decades. There's a correlation of about 0.7 between lending standards and the level of distress in credit markets, Fridson's data going back to 1997 show. The distress ratio, and this is the important metric, which is the proportion of bonds trading at a spread of 1,000 basis points or higher, fell to just 3.7% in January, well below the 12% historical average, and down from a recent peak of 10.4% in March 2023, because it doesn't look like a recession. And so everybody, including Japanese carry traders, have been piling into risky junk assets thinking this is not the traditional recession, therefore what do we need to be worried about? And the lower credit spreads go, the more the market is convinced that's the case. As I said, the lower credit spreads go, the more it looks like the economy's fine, and the more that we know the economy's fine because credit spreads are reflecting positive economic fundamentals, when it could not be farther from the truth. Huge historical degrees of complacency in credit spreads as well as the stock market. Stock market valuation in some places getting up to dot-com peak levels. Huge amount of complacency for an economy that is not in good shape. It just doesn't look like a recession that everyone imagines is the only thing that recession can look like. And the more these spreads go down, the more valuations of the stock market stretch, it's like a coiled spring just waiting for something to trigger it. Again, you start thinking, you start understanding what maybe Warren Buffett is thinking here, especially with the focus on the banking sector, which is where you'll see all of this stuff really start to play out as these fundamentals continue to go sideways. As we continue to forget how to grow, eventually it starts to look more and more like the recession that everybody will recognize as a recession. But back to Bloomberg here. The distress ratio staying low for a protracted period is, quote, a tinderbox waiting to explode. That's Phil Brendel, who's a senior credit analyst at Bloomberg Intelligence. The geopolitical situation is extremely volatile, and I do think that at some point we're going to see some kind of event that's going to cause more havoc than we are anticipating. And I think we're really wound up. And that's what Buffett is seeing. That's what a lot of veteran Wall Street traders and credit analysts are seeing. They're seeing fundamentals that they may think are perfectly fine, but they're not great. They're certainly not the recession everybody looks at and everybody recognizes. Fundamentals aren't awesome. A lot of cyclical signals flashing warnings and historic levels of complacency. It's a bad mix. They mentioned this Federal Reserve Senior Loan Officer Opinion Survey, or SLOOS, and that's exactly what they showed for their January update. For commercial and industrial loans, those made to large and medium-sized businesses, there was a net tightening of standards in the January statement or the January report. Now, standards have been loosening with lower interest rates going back to the third quarter of 2023. And that's not an accident. In fact, that's one of the reasons why there's been so much complacency, because there's this theory in the marketplace that any stress in credit, because it's not a recognizable recession, forgot how to grow, doesn't fit within the pattern or the template. Therefore, the only problem to be concerned about is lower interest rates. So as market interest rates went lower from the third quarter of 2023, credit spreads really started to drop because it seemed like that was the last and only threat to some of these riskier junk corporate issuers. And so as interest rates were going lower in the marketplace, senior loan officers reported not quite loosening standards, but fewer and fewer of them were tightening their standards. So the amount was about 50.8% in the third quarter of 2023. At the top, that's more than half of senior loan officers reporting their tightening lending standards to large and medium-sized businesses. That had dropped all the way to 0% in the fourth quarter of 2024, which meant nobody was tightening any further. They weren't loosening on average, but nobody was tightening. But then that jumped up to 6.2% here in the first quarter of 2025. And you see something similar for small business lending too. The SLOOS status shows a high of net 49.2% in the third quarter of 2023, those who were tightening standards, which fell all the way to 8.2% in the third quarter of 2024. But then those reporting tighter lending standards to small commercial businesses rose to 13.3% in the fourth quarter, and it was still 11.1% in the January 2025 update. Let's not forget what banks themselves are doing, the H8 data. Banks are not lending to the real economy or to much of the financial economy apart from private credit. And it goes all the way back to late 2022 and especially, as I pointed out recently, Silicon Valley Bank. The banking crisis showed that risks were high. The forgot how to grow economy was going to continue into the foreseeable future, not be replaced by an actual recovery, nor would it lead to a soft landing. Not only are banks not lending, they're also piling up safety and liquidity in the form of treasury securities and agency bonds. They're doing everything that Warren Buffett is doing, everything that you would expect for fundamentally what maybe doesn't look like a recession, but all of the outcomes and all the probabilities are there anyway. So from Warren Buffett's perspective, I mean, we don't know exactly what he's thinking, but we can piece together quite a bit of it. While we don't know for specific reasons, specific stocks, the overall climate, you've got stocks that are overvalued by any metric that you want to choose. At the same time, the fundamentals are not good. You got a high degree of complacency. That's, again, any metric you want to choose. Everyone is convinced that nothing bad can possibly happen, and Jay Powell just continues to pour gasoline on that fire. So bad fundamentals, even though it doesn't look like a recession, continued bad fundamentals, the sideways economy leads to a higher risk of everyone saying, well, maybe this is a recession. And if everybody starts to, it doesn't have to be every, just if enough people in the market start to believe that recession risks are rising, not falling, what happens? Exactly what we saw last August. That's what the carry trade blowup was really about. Except this case, it would be a lot further along in a path that maybe doesn't look like a recession, but if the herd starts to turn all at once, that would be a bad place to be in the stock market. It would be a very bad place to be in the stock market. The biggest cyclical indicator we have is the banking sector. And by cyclical indicator in this context, I mean the recognizable traditional recession. The forgot how to grow economy has been leading into that direction the entire way. That's the cycle we've been in, and the banks are starting to see the consequences of it. So if you're waiting for the traditional recession signals before you're selling stocks, then sell the stocks before you even get those signals, because the chances of them happening are going way up, and that's what the banks are telling us. Whether or not that's what Warren Buffett is trying to tell everyone else through his share sales, that's an open question. But at the very least, it makes a lot of sense. And if all that makes sense to Mr. Buffett, it would certainly make a lot of sense to those in the bond market. Interest rates that may be making a move lower here. Talked about that in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's President's Day sale. Only 2 days left for it. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.